Hello and welcome to the third edition of Horizon, the video zine of JM Financial Services. In last decade or so, we've been hearing a particular phrase quite often, financial inclusion. And that's going to be the theme for this month's magazine. Why financial inclusion is so important, what it means, and the kind of progress that we have achieved as a country. These are some of the points that we'll discuss today. First of all, financial inclusion's importance must be understood in terms of the role it plays in sustainable development. As per United Nations report, access to financial services is central for development, and this access is what decides financial inclusion. Currently, India ranks reasonably low on that index as per various reports of certain agencies, but we've made some good strides. You also look at financial inclusion in another term, which is about the remittances by immigrants or migrant workers. A person of Indian origin living and working in another country and sending the remittances to India. The access must have an objective, because the person is working in some other country, the family is stationed maybe in a remote village in India or a city in India or a town in India. If it doesn't happen fast, then again often it loses purpose. The money should be accessible in time. These remittances also play a major role in alleviation of poverty. And as per a report by UNCTAD, the Agency of United Nations, their estimate is a 10% rise in remittances may contribute to a 3.5% reduction in the share of people living in poverty. In many cases, in many countries, these remittances have played a reasonably large role in development of the infrastructure, development of people, increasing consumption, increasing savings and investments, because this is nothing but foreign capital coming to India. And unlike many other forms of foreign capital, this capital comes and this capital stays within the country. And that inflow can help reduce or remove poverty. And from that point of view, the United Nations and the other related agencies put a lot of emphasis on this particular aspect of financial inclusion. Another report suggested that in 2017 there was a huge gap between the developed countries and the developing countries. So as per this report, 94% of adults in developed countries had a bank account. Compare that to developing nations, the number significantly drops to 63%. A drop from 94% in developed countries to 63% in developing countries. But more interesting was within the countries, the developing countries, the larger section of the excluded, financially excluded, happened to be the poor, the people who were less educated, women, and youth or youngsters. So there was a clear demographic pattern seen across the globe. and that is worrisome. If this divide is allowed to widen, there could be social unrest at some point in time and development can take its toll. So the concern really was to address the gap between urban and poor, elderly and the youth, poor and rich, men and women, educated and less educated. So UN came up with what they called Sustainable Development Goals. And some of the Sustainable Development Goals depend on financial inclusion. So let's understand what financial inclusion means. As per a committee set up by Reserve Bank of India under the then RBI Governor Dr. Raghuram Rajan, it defines financial inclusion as a process of ensuring access to financial services as well as timely and adequate credit being available as and when needed at reasonable cost or affordable cost to the vulnerable sections of the society, which are really the low income groups, which are the low assets group. So the poor need to have access to financial products and services, number one, and within that, timely access to credit at affordable cost. That's the definition that RBI has come up with. And if you look at that and look at the Sustainable Development Goals of United Nations, so there are 17 goals that UN set up for the world, out of which 8 are related to financial inclusion. And then if you extend it further, the basic products and services from the financial markets, financial universe that we can highlight are basic transaction banking facilities or transaction related facilities, making payments, receiving money, whether it is within the country, across the border, whichever way. Protection from various risks, and this protection in form of insurance, access to insurance, access to credit or loans at affordable rates, savings and investments, and old age income security or securing retirement. So look at the requirements of people, and these are the broad areas where financial inclusion comes in. Now one may also say that yes, these products and services may become available, but some of those products and services could be complicated, and that's where advice may be required, and that advice also may be added as a service in this list. Fair point, but the broader areas are these. And within those broader areas, access, transaction costs, the speed, the accuracy are critical areas. And that's where a major breakthrough happened when mobile phones penetrated and the access to internet through mobile phones changed lives for a lot of people, because in the world of finance, whether you call it mobile banking, whether you call it the innovations like M-Pesa, or whether you call it digital banking, digital payments, whatever name you want to look at, the access to mobile phones revolutionized the financial inclusion landscape. And from that point of view, maybe in last 3-4 years in particular, post the breakout of the COVID-19 pandemic, when the lockdowns started, the penetration and usage of technology or adoption of technology just happened at a pace which was unprecedented, bringing more and more people under the formal financial system. What have we done as a country? In many discussions about financial inclusion, the initiatives taken by India are used as examples. Take for example the JAM Trinity, Janadhan accounts, Aadhaar number or ID and mobiles. These three combined together, and today a significantly large part of Indian population has access to formal banking system, formal financial system, and the transactions. We've actually covered this in the earlier issues of Horizon videos where we talked about UPI and the rate at which the transactions are growing. That UPI is adoption of technology for financial inclusion. It's a game changer. It cut the transmission losses, as we may call it, as the number of intermediaries were reduced. The money was directly going from the designated bank accounts of the Government of India to the beneficiary's account. The probability of leakages came down drastically. Now, this direct benefits transfer would not have been possible had it not been for the spread and adoption of technology. As we just said some time back, the entire spread of technology speeded up financial inclusion. This was a case of remittance from a government agency into a beneficiary's account, and that remittance was happening at the speed of thought. The government also came up with some of the schemes to ensure that more and more number of people can get access to some of the basic products. One of the things that they did was they instructed the banks to have a basic services account. And this basic services account is also called no frills account, where a lot of additional services are stripped off and a simple basic bank account is offered. At least somebody starts to operate in the formal financial system. But on the other end, there are many other products which were launched. Let's look at a few. The Janadhan account Yojana, which we just discussed while talking about JAM Trinity, Pradhan Mantri Janadhan Yojana, the bank account. Pradhan Mantri Jeevan Bima Yojana, now moving from bank account to protection. And along with Jeevan Bima Yojana, Pradhan Mantri Suraksha Bima Yojana. So while the first one, Jeevan Bima Yojana, is a life insurance product, Suraksha Bima Yojana is a health insurance product. Pradhan Mantri Mudra Yojana, which is availability of credit, where the ticket sizes are small. 50,000 rupees loan, take it, start your small business. And many states have rolled out this scheme in a very, very effective and successful manner. Stand Up India scheme. This is something where unemployed youth can stand up on their feet through availability of credit. And then came two other schemes which were related to retirement benefits. Atal Pension Yojana and Pradhan Mantri Vay Vandana Yojana. Atal Pension Yojana is for the accumulation phase of retirement where you invest, the government also contributes some from their side, and over a period of time you build your retirement corpus. And then the Pradhan Mantri Vay Vandana Yojana where you invest that corpus and take some payouts on a regular basis to fund the regular expenses in retirement years. So all these products are available to ensure that more and more number of people can get covered. The beauty of all these initiatives is that as more and more number of people come under the formal system, the addressable population for the finance industry expands. And at one point in time, when, if you look at the number of Indians having bank account was less than 40% of the population, number of people investing in capital markets was less than 2%, number of people having life insurance and health insurance coverage was less than 3%. The moment more number of people get into the financial system, we can achieve a target of reaching out to 80 or 90 and possibly even 100% of the population. And when that happens, India would be a very different country. But as they say, every black cloud has silver lining. You can also look at the other side. Every bright thing also has a shadow. And that shadow could be lack of education, lack of understanding, lack of financial literacy. And for that purpose, a few initiatives have been taken. The industry has been asked, for example, mutual fund industry was asked to spend some amount out of the money that they manage for the purpose of investor education. The stock exchanges, the depositories, they spend some amount. And the regulators themselves have come together. All the four finance sector regulators, that is SEBI, RBI, IRDAI and PFRDA, along with NISM, they came together to form an institution called National Center for Financial Education. And this institution imparts training, imparts knowledge in multiple forms. So let's look forward to an India that is wealthier and financially literate, financially educate. And when that India really stands up against the world, it has the potential to be a superpower. So let's wish all of us the best of luck. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.